Target date retirement funds are a really popular investing product these days that you can find in almost any 401k or 403b plan around the country. And coincidentally, they're an investment product we get quite a few questions about in our financial planning firm. So in today's video, we're going to cover target date retirement funds and their pros and cons. And we'll cover the information that you need to know to decide whether they're a good fit for you and your family and your personal situation. We'll cover what target date retirement funds are and how they work, reasons you might want to use one, reasons you might not want to use one, and a few of the common questions that we get asked over and over again. Let's start with what target date retirement funds are. Target date funds go by a lot of different names. Fidelity calls them Fidelity Freedom Funds. Schwab calls them something else. Anytime you hear the term target date, that means that it's a target date retirement fund. Target date funds are a lot like Costco. When I go to Costco, I walk in and I can buy soda or beer or food or socks or toilet paper or tires or vacations or cars. You can buy anything you want. Costco is now a one-stop shop. And that's exactly what target date retirement funds are. Anytime we're investing, we want to be diversified. We want to choose investments that align with our objectives and our risk return requirements, our time horizon, which usually means if you're young and you're accumulating assets, you're saving, you have a long time until you need to use the money you're putting into an account, you should probably be taking some more investment risk because you'll get more returns from that. There's this golden rule, this golden trade-off between risk and return anytime we're investing. And when you're young, you usually have the capacity to take some more risk than when you're older. So when we go to investing, when we go to invest, we have to decide what kinds of investments are we going to choose. Are they going to be stocks or bonds or real estate or cash or gold or oil or crypto? There are a ton of different options. And the balance that you choose between all those options determines how risky your portfolio is. If that sounds like a lot, if it sounds overwhelming, that's precisely why people invented and came up with and started using these target date retirement funds. They're a one-stop shop. And so the idea is that there's a manager of this one fund that's going to buy a whole bunch of stocks and a whole bunch of bonds, maybe put a little bit in cash, maybe a little bit in real estate, in a way that aligns with the target date on the fund. So for example, a target date fund with a long time horizon, maybe a 2060 fund, which is almost I guess is 37 years from now, from the time that I'm recording this video, it has a long time before the retirement date. And because of that, most of the portfolio will be put in stocks because someone retiring in 2060 has a lot of risk capacity at that time. They can withstand a drop in the markets, and therefore, most people are going to target a little bit more return in their own portfolio. Now, these are fund of funds investments, and generally they're fund of funds investments. What that means is that there's a manager of the target date fund, of this 2060 fund, and they're choosing a couple of different underlying funds to put your money into. It might be a total stock market index fund. It might be an international stock fund, maybe the emerging markets. It'll be maybe one or more different bond funds. And so rather than you having to take your dollars, put it into your 401k or your investment or retirement account and choose what investments to purchase and then make the purchases and then rebalance it over time and figure out, how does my risk look? Am I too risky? Am I too conservative? You're basically, by purchasing a target date retirement fund, delegating that to the manager of that fund. With the target date a long ways away, it's risky. As you get closer to that target date, the manager will become more conservative on your behalf. They will take assets away from the stock portion of the portfolio, add them to the less risky portions of the portfolio, like bonds, so that you don't have to figure that out on your own. Let's talk about the pros and the reasons you might want to use a target date retirement fund in your retirement accounts or your other accounts for that matter. Number one is it's a great one-stop shop. Like we're talking about, it can be overwhelming choosing amongst a whole bunch of different investments. If you open a brokerage account today and you put money into it, you can buy any stock under the sun. You can buy any fund, any ETF, any mutual fund. There are a million different things that you can invest in, and figuring out what to purchase can be kind of challenging. If you're putting money into a 401k or a 403b plan at work, they probably have a menu of investments for you to choose from. That can be overwhelming too. A lot of these 401k, 403b plans have 20 or 30 different options. And for you deciding how much of your paycheck to put in each one, it can be a lot. So the benefit of using a target date fund is you just choose one thing. You put all your money into one fund, and the manager of that fund, again, is going to be responsible for being more conservative over time as you approach the target date. And that's a good thing. The second thing is that they're easy to set up. You don't have to make this choice over and over again. And every time you put money into the account, purchase more shares of this fund, you can set it up to where it's automatic. You make the election once if you're contributing to a 401k or a 403b plan. If you're doing this on your own in like an IRA or a Roth IRA or a taxable account, you can set up consistent contributions to be invested in this one option automatically on your behalf so that you don't have to. You can set it up to where money comes out of your bank account every single month and automatically goes into this target date fund. So it's a good one-stop shop. It's easy to use. They're not perfect, okay? And we'll get to the drawbacks here in just a second. They're not perfect, but they're good enough. They probably get you 80, 85% of the way there, to be honest. And for a lot of people around the country, around the United States, 80, 85% is good enough. So if you're a younger person just getting started, you're not really sure where to begin with your company retirement plan, there's nothing wrong with target date funds. I've seen some videos that have given them some flack recently. They do have their drawbacks. They're not perfect, but they get you most of the way there. And that's honestly good enough when you're just starting to put money into the accounts for the very first time. Let's talk about the reasons you might not want to use a target date retirement fund. I saw a video recently claiming that you should never ever use a target date retirement fund because they were 3, 4 times as costly as the underlying index funds that the target date retirement fund is investing. And I think now that is accurate, and I'll get to that in a second, but that is completely ridiculous because yes, they may be 3, 4 times more expensive. So if you buy a total market index stock fund, it might cost you 0.05% per year these days. And if you buy the target date retirement fund instead, it might cost you 0.2% per year. I'm pulling those numbers out of thin air. Realistically, you're talking about the difference between paying a dime a year for help and maybe 25 cents or a quarter per year for this kind of help. And for a lot of people who are good fits for target date funds in the first place, they'd happily pay a quarter to have an investment manager handle the asset allocation on their behalf as they get older and probably should be more conservative. There are 3 other legitimate reasons that you might not want to use a target date fund in your situation. The first one is relatively obvious. They're a great fit for a one-stop shop kind of person who has very ordinary circumstances. If you have anything other than ordinary circumstances, if you're anything other than plain vanilla, you might not want to use one. If you're planning on borrowing the money out of your 401k to buy a house or start a business or something, then your personal target date and time horizon and risk capacity is different than what the target date fund manager is managing to. That might not make you a good fit for this. If you're someone who wants to retire early and move down to Mexico and go fishing every day, that might not be a good fit for you. There are a million reasons and a million unique circumstances that might invalidate the benefits of using a target date fund, and you just need to be aware of that in your own planning and your own investing. The second reason, or second drawback, I should say, about target date retirement funds is that pretty much any target date fund that I've ever seen becomes overly conservative as you get close to that target date. And the reason for that is that the managers of these funds are trying to manage risk of a portfolio on behalf of a whole bunch of different people with completely different needs and risk requirements. Usually, investment managers are only managing a bond fund or a stock fund, and they allow the investors in those funds to decide on their own, well, how much of the stock fund do I want to buy? How much of the bond fund do I want to buy? But when you have a manager making that decision on behalf of a big number of people, they're all going to have a huge variety of different risk return appetites and capacities to take general investment risk. And so for that reason, if this is the exact correct amount of risk that everybody should be taking, and here is too much risk and here is too little risk, any prudent investment manager who's a professional is probably going to err on this side as opposed to this side. And for you, that might simply be too conservative, at which point you probably want to become a little bit more surgical with your investing and take a look at it yourself, maybe rebalance and get out of the target date fund at that point, or consider working with a professional for some kind of help. So for younger people who are just starting to put money into the accounts for the first time, this is really a great fit for a lot of them. But as you get older, as you get closer to that jump off date where you're going to actually need the money that you're putting in the account to keep the lights on and buy groceries, pay for healthcare, and all those fun things, you might want to think about doing something else because oftentimes a target date fund is going to be too conservative. The third drawback of target date funds, this is going to be a little bit more technical, apologies for that, is that most target date funds are using index funds to build the portfolio. And index funds, by and large, are great. I'm a huge fan of index investing in general, just to be totally clear. The issue is that the way that investment companies build the index and decide what companies go into the index and are added to the list and in what portions simply depends on their cap size. They're called cap weighted. And generally, what that means is that your growthier tech companies are going to comprise a larger portion of the portfolio than your value companies that are not growing as fast. And oftentimes, what we see in target date retirement funds is that the stock portion of the portfolio is really skewed toward growth. And so you're going to have more tech companies in there than more stable companies, long-term cash cow kind of companies like Coca-Cola and Procter and Gamble that pay a nice dividend. You'll have them all in there, but you'll have more tech than you will other value-oriented companies. Now, there's a lot of evidence and empirical support for the fact that the performance of value companies tends to be a little bit higher than the performance of growth companies. We don't know what's going to happen in the future, but historically, that's been the way that it's played out. And so, if you're someone that is thinking, yeah, we're in the middle or the beginning of this new AI revolution, I really want most of my portfolio to be invested in the Nvidias and the Microsofts and the Apples and the Metas and Googles, companies like that, then a cap weighted index fund could be great for you, which most target date funds will use, and that could be a reasonable fit. But if you're someone who's wary of that and wants the maybe more slightly more conservative option, then you probably don't want to abandon your allocation to the tech companies and the Nvidias of the world. You might just want to level the playing field a little bit, not to a completely equal weight, but just a little bit in the other direction to balance things out. And your average target date retirement fund is not going to offer that. So same situation applies. They're a great one-stop shop for a lot of people, but if you want anything fancy or tailored to your specific circumstances, target date retirement funds are not going to do it. So here's a couple questions we get very frequently about target date retirement funds in general. One of them is that, well, I've always heard I don't want to put all my eggs in one basket, yet you're saying that I can put all of my savings into this one investment. Doesn't that come with a whole lot of risk? And what I'm saying is that it's okay in this circumstance because you're not putting all your investing dollars into Apple or into Chevron or one company that comes with a lot of specific risk. You're putting all your money into a fund whose manager is buying thousands and thousands of different companies. And so exactly what's in the portfolio is going to differ a little bit company to company, meaning Fidelity versus Vanguard versus Schwab versus BlackRock and so forth. But in general, you're going to have maybe more or less 10,000 different companies in your portfolio, 10,000 different stocks in your portfolio when you buy a target date fund, and at least several hundred different bonds. And that is very, very diversified. Now, what happens if I buy a Fidelity fund and then Fidelity goes bankrupt? Well, that's where the Securities Investors Protection Corporation comes into play. That's where all the checks and balances and rules and protocols in the financial industry come into play. If Fidelity goes bankrupt, When you gave your money to that portfolio manager, they didn't just sit on it and promise to give it back to you in the future. They took it and invested in all the underlying securities, and the securities in that portfolio, the shares that you own by virtue of holding that target date retirement fund, all sit in a trust account somewhere. So if Fidelity goes away and you own the Fidelity target date fund, that doesn't necessarily mean that you're going to lose all your investment. And for that reason, you're not taking the I'm putting all my eggs in one basket kind of risk in this circumstance, because the fund itself is really diversified. Now, another question that we get is, well, what year should I choose? This is a hard decision to make. If you have no idea, if you have no other bearing, if you're maybe in your 20s or 30s and you're truly not sure, just pick the date that aligns closest with when you're going to turn 65. It's as easy as that. Again, everybody's different. This is not advice. You need to, consider a lot of other factors in your own planning. But if you're truly not sure, most people out there want to work somewhere around their until they're in their mid 60s or so. Choose the date as a starting point that aligns with when you're going to turn 65. When you're 65, you're old enough to file for your Social Security benefits. You're old enough to take money out of your 401k without paying some kind of penalty. And it's generally the age at which we start thinking about retirement for most people around the country. And so that's a good start. If you have a good reason that maybe you're 60 now and you want to work another 10 years, great. Then match it up with the date that aligns with your own personal horizon. So I would start with 65 and then work forward and backward accordingly. Now, the last one the last question we get relatively frequently is, well, what's the best company? What company should I choose? Should I choose State Street or BlackRock's target date retirement fund? Should I choose Vanguard's or Schwab's? They're all relatively similar. They're a little bit different. Oftentimes, if you're saving for retirement in your 401k or 403b, you're not going to have a choice. You'll have a choice between which date to choose, but the funds that are offered in that menu will generally all come from the same company, like T. Rowe Price, like Vanguard. So you don't have that kind of discretion. If you do have that kind of discretion, do I want to choose Vanguard's or Schwab's? Then you probably want to look at what's in the underlying portfolio. You want to look at the expense ratios. If they're the exact same securities and one fund costs me 0.1% per year and the other fund costs me 0.08% per year, we're talking about pennies of difference for most people, unless you have a couple $1,000,000 in the account. But yes, if they're otherwise identical, I would choose the less expensive option. So those are a few factors to consider in your own life, in your own investing, and in your own decision making. But that's generally how we think about these things. They're great one-stop shops. We use them in some of our clients' accounts, circumstances depending, especially if you're just getting money into the 401k for the first time. But if you have any kind of special circumstances or you want anything fancy or more personalized with your portfolio, these are quite simply not it. I hope you liked today's video. If you did, make sure to hit the like button at the bottom of the screen and subscribe to the channel to make sure that you're notified anytime we come out with something new. And on top of that, if you're not sure whether you're on track financially, you might want to check out our free wealth gauge assessment. There's a link for it in the comments. Basically, you click the link, you take 3 minutes to fill out some basic financial information about yourself. We take that information and run it through our financial planning software. Then we send you via email a short private video of our findings and 30,000-foot observation.